They're not going to go out and buy gold, silver futures and use leverage, and they're probably not going to use double long ETFs of bullion. They're going to go for the gold miners and silver miners. And since that's such a tiny little sector, and it's so undervalued, not only in relation to gold, but in relation to the S&P, it won't take much money flow, the blood flowing out of the stock market into some other category, to boost the gold miners off the page, because they're such a tiny little asset category. And we expect to see that in 2025, where suddenly the perception that miners are dogs that, lag gold all the time, and they don't. Sometimes they actually lead. People overlook that. But they'll go into a leadership position, and I think that's probably going to be the best place to be on the planet, is in gold and silver miners in 2025.
In 2025, gold and silver miners are expected to become a standout investment as money flows shift from traditional stocks into undervalued assets. These miners, a small and often overlooked sector, are significantly undervalued relative to gold and the S&P 500. As investor interest grows, even modest inflows could drive substantial gains due to the sector's size. Historically seen as lagging behind gold, miners are anticipated to take a leadership role, making them one of the most promising investment opportunities for the year. Michael Oliver, a prominent financial analyst and founder of Momentum Structural Analysis, MSA, explains the current bull market, which began in 2009, is unlike previous bubbles like the dot-com boom of 2000 or the 2007 mortgage crisis. This prolonged market expansion has been fueled by artificially low interest rates and unprecedented money supply growth. For most of the past 15 years, borrowing costs were near zero, effectively making money free. This distorted the pricing of money, the most essential commodity in any economy, leading to widespread errors in individual, corporate, and macroeconomic decisions. The massive growth in the M2 money supply further eroded the actual value of money, creating a fragile financial system dependent on central bank intervention. Michael points out that as these distortions unravel, central banks will likely respond with aggressive rate cuts and monetary expansion, as seen in past crises. However, history shows that such measures fail to prevent market collapses once a downturn begins. In the face of this inevitable correction, central banks will act unison to stabilize markets, but the damage will already be done. The beneficiaries of this monetary desperation will be gold and silver, making them the most attractive assets for 2025 as the financial system grapples with the consequences of prolonged artificial stimulus. Stay tuned for more insights in the video, and if you're enjoying the content, don't forget to like and subscribe for the latest updates.
2007 high was a bubble, it was mortgage defaults and all that stuff. And then 2000 high was the dot-com bubble. And in 1929, of course, everybody thinks that was a bubble, and we collapsed to 1932, wiped the thing off the page almost, percent-wise. It took decades to get back to it. So those are things people call bubbles, but this bull market bubble that we've had since the 2009 low has been created by factors that are so bleeding obvious that when you go to the Federal Reserve of St. Louis and click through some charts, and I suggest looking at M2, for example, the money supply, and looking especially at the Fed funds rate chart, you'll see that we've had interest rates by the Fed, the short end of the market, near zero for 15 out of the last 15 years. About 10 of those 15 years we were at zero. Money was free. And even when they raised it recently, and now it's starting to back off again, even those levels are historically very low levels. If you go back 50 years on that M2 chart, you'll see even though they raised rates recently, they're still very, very artificially low cost of money. When you have that sort of embedded error, fundamental macroeconomic error being the pricing of money, most essential commodity in any transaction throughout the world or domestically. It's the most essential commodity because when I buy from Mr. A to buy a product and he gets the money and I get the product, he wants to be sure that what I give him is actually got a whole value between now and next year, and so forth. And if it's changing in value because of the quantity of money increasing drastically, in the last 15 years we've had more money growth than we've had in any other 15-year period, percent-wise, decay in the real value of the money. And then we've had artificially low rates. So that creates errors, individual micro errors, family errors, corporate errors, and they're protracted over a very long period of time. We're not talking about a 2-3 year bull market that's busting. We're talking about a 15-year bull market that went up like 5 times more percent-wise than any prior bull market. And you can say, well, it's a good, strong economy. Yeah, right. It's due to look at the M2 chart. We've been drug infused with M2 money growth and with free money, effectively, for so many years that it's as if we've been administered hallucinogens by the central bank. And so when those errors start to get ripped open and exposed to the wound, and you start to hemorrhage, then it's beyond the control of the central bank at that point to then sort of, oh, we made a mistake. Let's go back and fix it. They always try to. You go back and look at the 2000.com top. They started cutting rates in early 2001 dramatically. All the way down, the market collapsed. Nasdaq went down 82%. Rate cuts didn't save it. 2007 mortgage peak, we collapsed 50%. In S&P, they cut rates all the way down. It didn't stop it from collapsing. So this time around, even though they're going to cut rates, they've already started, once the stock market peaks, that's historically when you see the data points, the things like they like to talk about. What's unemployment look like? It's factory output. All those metrics that the Fed likes to look at will suddenly go dark. Not before the market breaks, but after it breaks. That's when it occurs. And at that point, the central bank, not just ours, but others, will go into panic mode in unison. They work together. And that will create monetary expansion globally, not just here. And desperation and moves by central banks to buoy their assets they deem worth buoying, like the stock market.
In his latest interview with Elijah at Liberty and Finance, L exposes how gold and commodities, including industrial metals like copper, often perform well during economic uncertainty, even when stock markets falter. Historical examples, such as the late 1970s stagflation, saw commodities and gold rise sharply while the stock market struggled. While there are isolated instances where gold temporarily declined alongside stocks, such as in October 2008, these are exceptions rather than the norm. Gold's corrections during these times were brief, and it often rebounded strongly, outperforming equities over the long term. For example, during the dot-com bust from 2000 to 2002, gold experienced significant gains while the stock market languished. Similarly, while the S&P 500 and Nasdaq took over a decade to recover from their early 2000 peaks, gold surged, highlighting its role as a reliable hedge against economic turmoil and currency devaluation. Investors who failed to pivot to gold during these periods missed substantial gains, underscoring the importance of focusing on broader trends rather than short-term anomalies. Now, let's dive into the interview.
Because they're monetary, they're money. But even raw commodities like copper, let's say, an industrial metal, looks poised to go up while the stock market goes down. If you go back and look at the late 70s, we had stagflation. Economists couldn't figure it out. How can you have inflation and yet collapsing, a wasteland in the stock market for a decade almost? And yet commodities exploded all during that time, the 77, 78, 79, and 1980. They went up with gold, not as much, but they went up strongly. And yet we're in a global recession. So the examples that people remember, they're burned in their memories, are very isolated instances where gold temporarily had a bad month along with the stock market. Before I founded MSA in 1992, and we only had institutional clients at that point, I caught the crash in 87. I didn't catch it in a big way. I caught it in a small way, but I did it with puts. So I got my customers in it as well. I was a futures broker. And I learned a lesson. But during that collapse, and gold wasn't even in a dynamic market at that time. It wasn't, you wouldn't define it as a super strong bull market. But stock market collapsed, gold went up 10% that week. Same week that stocks went down 30-something% and went up 10, okay? So, but you go back to that 2008, 7-8 bear market. In October of 2008, there was a crash type event in the stock market, but it was a full year off its high. It had already been in a bear trend since September, October of 2007. So in October of 2008, way off the price high, a lot of time off the high, it had a 30% collapse month. It takes that dimension for it to be labeled crash, 30 plus in a couple of weeks. And gold at that point had been rising sharply in that period of time, but suddenly in August, September, and especially October, gold had a relapse. It needed to have a correction. It was technically ripe to have one, but it lasted basically 1 month where it was doing the same thing as the stock market. And then the stock market continued down until March of 2009. Gold was back at its highs by then. People ignore that. So yes, there was a 1 month phenomenon. Also, COVID event was another time. But they're isolated events and they're not part of major trends. They're hiccups. And yet people seem to have that only in their mind, not the major trends. And if you go back and look 2000 to 2002, major bear market, dot-com collapse, gold was up all during those years. Okay? And from 2000 to 2011, gold had a massive up move had an interruption in October 2008. But during that same period of time, the stock market was not performing well. It was in a lateral position since its 2000 high. In fact, after the 2000 peak, it took the S&P 13 years to finally go up and exceed it and move on up. It was until 2013. For the NASDAQ 100, after it peaked in the year 2000, it collapsed, and it was 16 years before it could ever get back to the price high that it had seen in 2000. So if you factor in, if you didn't get out in 2000, and by the way, MSA put out a major sell signal in January. Yeah, it took it about a year to collapse, but it finally did. But it took it 16 years. Imagine not having gotten out and not gotten long gold during that time. Gold was very cheap then, year 2000. It went up through 2011. It took you 16 years to nominally get back to the price high you saw in 2000. I say nominal because the degradation of money over that 15 years, the real buying power, collapsed big because, the money supply almost doubles every decade. So you've got to keep that in context. A lot of people are too focused on one minor event here and one there. They isolate and they don't see the real context.
In 2025, as economic uncertainties mount and traditional markets falter, gold, silver, and other commodities are poised to shine as reliable hedges against instability. With historical trends affirming their resilience and the potential for significant gains, investors should prioritize these assets amidst a shifting financial landscape. How might central bank policies in 2025 further influence the performance of gold and silver? What indicators should investors watch to confirm a sustained upward trend in commodities? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.